What is risk to reward ratio and win ratio? Now, risk to reward basically means how much money are you making whenever you are risking 1 rupee. So for example, risk to reward is 1 is to 2. Now if I am taking 1 rupee risk in my trade, then I should be minimally getting 2 rupees profit for every 1 rupees that I am risking. So for example, if I am buying a stock at 100 rupees and my stop loss is at 10 rupees, that is 90 rupees, right? So my minimum target in this case should be 120, so that my losses are getting covered whenever the profits are being made, right? So with risk to reward 1 is to 2, you can be profitable over a period of time. How can you be profitable with a risk to reward of 1 is to 2 and a win ratio of say 50%? Now basically what does win ratio mean is, how many trades are you going to win out of 10 trades? Say we will have a sample of data, let's say 10 trades. Now out of 10 trades, how many trades are we winning? That is what matters in a win ratio. So if we have 10 trades here, and let us divide that, we are going to win 5 trades and we are going to lose 5 trades. So if we are going to lose 5 trades here and we are going to win 5 trades, now even with 1 is to 2 risk to reward ratio, we are going to be profitable. How is that possible? I'll just show you in simple mathematics. For example, whenever we are going to make whenever we are going to make money, we are going to make 2 rupees, and whenever we are going to lose money, we are going to lose 1 rupee on this side, right? So this is risk to reward ratio plus win ratio. Now in these 5 trades, we are going to make 5 into 2 rupees, that is 10 rupees, and in this 5 trades that are the loss making trades, we are going to lose 5 into 1 rupee, that is minus 5 rupees. So at the end of the day, we are at a net gain of plus 5 rupees. And if you include some brokerage and everything, let us say that we are at the end of the day, we are at a profit of plus 3 rupees, right? So this is the meaning of risk to reward ratio. And as the number, or as the win ratio increases, for example, you can be even profitable with 30% win ratio. How can you be profitable with 30% win ratio? Then you need a risk to reward ratio of more than 1 is to 3 to be profitable. Let us see in an example of how to understand how we can be profitable with only 30% win ratio. Let us say that we have taken 10 trades. We have taken 10 trades, and in these 10 trades, we have only 7 trades that are loss making, and 3 trades that are profit making, right? So we have understood this thing. Now in these 7 trades, we have lost 7 rupees. That is, if we are keeping a risk to reward ratio of more than 1 is to 3, we have lost 3 rupees. In these trades, we have lost 1 rupee. So 7 into 1 is 7 rupees that we have lost, minus 7. And in these 3 trades, we have made plus 3 into 3, that is 9 rupees. So this is just an example to show you how we can be profitable if we maintain a proper risk to reward ratio. Now we need to understand what is the drawdown, and how we can, how we should be protecting our losses. Now if we have a drawdown, let's say of 5%, now to overcome that drawdown, we require around 5.3% return to overcome, to come back to break even. So for example, if we have 10% drawdown, we require 11.1% just to get back to break even. This is a figure to understand how losses play exponentially against you. Now as your losses start to increase, your break even points start to increase exponentially against you. For example, if our loss was here 50%, let us assume that our loss is 50%, so here our break even point would be 100%. So we require 100% gain just to break even our losses, right? So what do you mean by losses and 100% break even? So for example, if we have bought a stock at 100 rupees, let us say we have bought a stock at 100 rupees. Now we have faced 50% loss in that, and our stock is now trading at 50 rupees. So just to get back to break even, or just to get back to the capital that we had deployed, we require 100% gains. Then only the stock at trading at 50 rupees will go back to 100 rupees. So this is known as losses working exponentially against us. Now once you see that losses work exponentially against us, we have to reduce our losses as far as possible. Now that is the scenario where most of the people are lagging and they are not able to control their losses, as they are not able to book losses in their accounts. So for example, if we have 70% loss, we require 233% gains just to get back to break even. Let us look at the chart of Yes Bank. Now if we look at the chart of Yes Bank, we will see that the stock has fallen around 95% from the highs. Let's say that a person who has bought a stock at 390 rupees is still holding the stock. Now it is trading at around 13 rupees, so the stock has lost 97% of its value over life, just for a stock to get back to break even. Now if the person who wants to come back to cost, he will require 3000% gain just to get back to that break even point. So let us assume that you have bought the stock at 150 rupees. Okay, to get back to 150 rupees you require 1200% gains. Do you think that over a period of time, or do you think it is logically possible just to get back to break even? No, it is not possible. Even if you stay in this stock for, say, let's say 5 years or 10 years, so we do not know what is going to happen over the next 10 years. But definitely if we try to reduce our losses, that let us say to maximum 25%, because even at 25% gains we require 33% to get back to break even, right? So this is what is managing losses is meant by managing losses. And you have to think in terms of risk to reward. If your risk is say 10%, your reward should be minimum 20%, so that you are profitable over a period of time, over a period of 10 trades. Now I am not suggesting you to keep a risk of 50% and keep a reward of 100%, because you will not get reward of 100% regularly, but you can get a reward of 20% regularly with a risk of 10%. Position sizing. Now, position sizing forms the cornerstone of a trading system. The recovery of capital is much more difficult task than one can imagine, and traders with small account have a tendency to take larger bets, which they need to avoid. As we have already learned that a 5% drawdown requires 5.3% efforts, that is 5.3% gains just to get back to break even. A 25% drawdown requires 33% gain to get back to break even, and a 50% drawdown that we have seen requires a 100% gain to get back to break even. So keeping stop losses into the system is really important if you want to stay into the trend for a very long period of time, or if you want to make money in the markets, then you need to keep a stop loss. And the thought of not keeping a stop loss will only make your capital wipe out over a period of time. Right, now we will understand what is position sizing. Let's assume that we have a capital of 1 lakh. So stock allocation should not be more than 20% of our capital. What does that mean? Basically, if we have 1 lakh capital, we are not going to deploy more than 20,000 per stock. So this is the maximum that we are going to deploy. Ideal stock allocation should lie from 5 to 10% depending upon the conviction in that stock. Now total risk in the trade is 1000 rupees. So we have assumed that we are not going to risk more than 1% of our capital in any go. We can increase this risk depending upon our risk appetite. So it could last from 1% to 3% depending upon our risk, right? So here we have taken an example of 1% of our capital. Now stock price is 500 rupees. Let us assume that the stock price is trading at 500 and risk in that trade was 5%. That was 25 rupees of the stock price, right? Now what should be the total quantity that we should be buying? The total quantity we should be buying depends upon our risk appetite. That is the first thing. And the second thing, what is the total risk that we are taking in that particular script? In our scenario, we are willing to lose, that is maximum 1000 rupees in that trade, and we are going to lose 25 rupees per stock if we are going to lose money in that. Now this is the total quantity that we should be buying of that particular script. That comes at around 40. Now if we buy 40 quantity of that stock, we are going to lose 40 into 25, that is 1000 rupees maximum in any case, right? So this has to be predefined whenever you are going to take a trade. Whenever you are going to take, first you need to decide what is the maximum SL that you are going to take. Second thing, you need to decide what is the maximum loss that you can take in that particular script. So it could be 25 rupees also, it could be 30 rupees, it could be 10%, it could be 5%, depending from stock to stock. So this is how you have to decide, that is the total quantity of that particular stock. So ideal position sizing for a trade is determined by dividing the money at risk or account risk limit by your trade risk. Let's take one more example to understand position sizing. Let's say we have a capital of 1 lakh and we have taken a limit of 2% per stock. Now in this case we are also going to limit our maximum stop loss at say 7% in any kind of stock. Now this is going to limit our losses on the downside in any particular stock. Now we have a stock trading at 100 rupees, we have kept a SL at 93 rupees, that is the 7% of our total buying price. Now in this case, what should be the ideal position sizing? Ideal position sizing should be maximum our loss should be 2000 rupees divided by 7 rupees, that is the maximum loss that we are going to face. So here this is the normal formula that we are going to use to define whatever the position sizing that we need to take in any kind of stock. You have to always remember that you have to decide what is the risk that you are going to take in that particular script, and this risk should be ideally constant whenever you are going to take a risk, and this stop loss could be modifiable depending upon that particular stock. Sometimes this can range into 2 to 3% also if it provides us a very low risk setup, or it could range to 7 to 8% also if it has a wide range setup, right? So depending upon our risk appetite, we are going to do a combination of this stop loss, that is the maximum percentage allocation in a particular stock, and this stop loss, that is the maximum percentage allocation for any stock in case of stop losses.